you have trade ideas. Everyone's got trade ideas. They want to be long for a breakout. That's a trade idea. Okay, we can all see a chart. We can see perhaps a double daily top coinciding with a weekly high and a market that's trending up. And we have this idea that we want to be long. Okay, it's an idea. It's nothing more than, we have this understanding that prices should go up. Now, that unfortunately doesn't equal an opportunity. Okay, just because you have an idea and it could be a good idea doesn't mean you have an opportunity. Why? Because without access to the trade idea, you only have a good idea but no repeatable edge. In other words, just because you think it's going up, if you cannot define something objective that tells you when the timing is right that it's going to go up, you cannot repeat that objective approach consistently. Okay, because what will happen in the future is, again, you'll see a chart where, okay, I think it's going to go up, but at the end of the day, where do you place that stop? At the end of the day, what's that signaling that tells you now's the time to get long? Because if you don't have that signaling, you cannot predetermine risk. And if you cannot predetermine risk, ultimately what you're doing is you're just taking an undefined amount of risk. Okay, so how you must think about access methodology, 3 steps. Step 1, you have a trade idea. Okay, like I said, we have a breakout. That's the why. We have this market, it's double topped. I want to be long for that breakout of resistance because I think the market's going to trend through there. Okay, it's an idea. Now, number 2 is the strategy execution. In other words, how are we going to execute? What are we going to do in terms of methodology, in terms of entry, stop, and target, based on what we typically experience with this type of pattern? And that's the how. It's how do we get involved in this breakout once the market gives me the signal that that breakout's about to occur. Okay. And then step 3 is what the access methodology is. It's nothing more than just a trigger or the timing or the signal. Okay, you often hear people talk about signaling, and when they mean signals, they mean, okay, if this moving average crosses over that, that's the signal to buy or sell. Okay, that is all access methodology is. It's a signal that uses price action to tell you when there is mass participation in the market. In other words, you're leaning on order flow, you're leaning on big time frame participants to say, I'm buying it now, therefore if you think it's a buy, you should probably join me. Okay, so we go a little bit back to front. We have an idea of how we're going to execute that idea, and then we simply just wait for the market to say, hey, your idea is now valid, I'm buying it, maybe you want to buy it with me. Okay, and that's the when, that's the signaling of the trade opportunity. Now, why do we use access methodology? Before I get to a few examples, we use it for 7, 8 reasons. Okay, number 1, it's a discretionary methodology that signals entry. In other words, it's a timing mechanism. It's telling us now you must buy, now you must sell. Okay, it's also a risk management solution because once we have access, by definition, if Goldman Sachs is saying, hey, I'm buying, the reality is we know where that stop is. Okay, that stop shouldn't go beyond that point where Goldman Sachs started to buy. All right. And in terms of timing, it gives us precision. All right. If we're waiting for the market to signal buy, it means we've got a precise timing as to when we think that market might break to the upside or to the downside, which means we're not preempting on opportunities. All right. Also, because we're going with large time frame participation, we're going with the momentum. All right. It means that we can use much smaller stops as well. It's very much 100% objective because it's signal based, because it's I have to see this in order for it to happen. It's 100% objective. There's no wishy-washy. There's no, oh, I bought it because of A, B, C, D, E. No, it's I bought it because the access signal was there. Okay. Number 7, it's simplified approach to trade execution. Right. What it does is it makes entering the market pretty straightforward. It makes placing stops very straightforward. The only thing you have to then focus on, of course, is targets. And this allows for consistency. And then finally, access is nothing more than the price action we want to see. Okay, think of it from that standpoint, which is I have this breakout, the S&P is about to go into record territory. I can see all these buyers coming in because my access has told me so. Therefore, now I want to buy it because I can see the kind of price action I want to see. That's all access methodology is. It's giving us the signal that now is the time to buy or sell the market. Okay, it's an objective signal to buy, sell the market. And most importantly, it's repeatable because we can mark it out on a chart. We can say, I bought it because there's the signal. I can go and back test because there's the signal. I can go and mark this out in future references because there's the same signal I saw on previous iteration. Okay, now I'm going to give you a few different types of access methodology. There is no hard, fast list. There's no, exhaustive list of types of access methodology. It's merely just a signal. So I'm going to give you 5 different types, but there are different ones. There's loads of different types of access methodology. You can develop your own access methodology so long as you understand what access methodology is. Okay. Now the ones I'll take you through and I'll give you a brief example of are things like auction candles, engulfing candles, key economic data risk events, consolidation zones, and key close prices. Okay, I'll show you and illustrate these for you now, give you an idea of what they are. What's important to understand is that access methodology includes many different types of objective price action. Okay, by definition, if we are just observing a repeatable piece of price action, anything could constitute price action. Right, but what's most important, I'm not going to go through this in great detail now. What's most important about access methodology, by definition, because we're looking for mass participation, we have got to have high volume. By definition, it can only occur when there's high volume, because low volume means we do not have participation. We simply just got a whole bunch of algorithms. Okay, so then why this makes a lot of sense. Okay, and the best example to use is, you've all seen engulfing candles before, and traditional teaching of pattern recognition and strategy suggests when you get a bullish engulfing, that's a buy. Now, in theory, some part of that is true, but most of that is false. Okay, the part of that is true that is, yes, when we do have this sort of outside candle of a previous red candle, that is relatively significant, so long as there is a high degree of volume and there is some consideration given to this first candle showing us there was participation. In other words, if this down red candle was a nice wide range and it had a high volume, that would suggest there was a lot of sell side activity in this time frame. If the next candle then reverses and does the complete opposite, where we have a high amount of volume, but now the buyers take absolute control of price, that is a significant piece of price action. Okay, it's not just, oh, I have one red candle and the next one's an outside candle, therefore I have access. No, it doesn't work like that. It has to be high volume. It has to be a high degree of price range volatility. That's key to understanding any access, is there's got to be a reference to mass participation. Okay, so there's an example of bullish and bearish engulfing. Some of the other examples, auction candles. Okay, if you've done any kind of market profiling, you will know that an auctioning candle looks something like this in market profiling. We have a bit of auction, we have a bit of absorption, we have a bit of absorption, auction, a bit of absorption, auction, absorption. Okay, in other words, market steps up, it finds a bit of liquidity, it moves sideways. It then steps up again, finds a bit of liquidity, moves sideways. It then steps up, finds a bit of liquidity, moves sideways. Okay, now auction candles are a very good piece of access, because it's telling us there is mass participation. It's telling us there's a large time frame institution taking the market up the page. Okay, we also have consolidation zones. So when a market sits inside, I'm just going to erase this. When a market sits inside a very good sort of absorption zone, a high volume zone where the market's trading out a lot of volume, okay, and it's pinging between 2 points, this absorption zone or consolidation zone at some point is going to resolve itself. Now, when we have these zones prior to key breakout levels, they act as very good access. Why? Because by definition, if buyers are fighting for price here and sellers are fighting for price here, and buyers are fighting for price here and sellers fighting for price here, at some point this resolves itself. At some point someone wins, and as a result, someone has to lose by definition. Okay, equally, don't forget, the market's objective, the purpose of the market, is to facilitate trade towards liquidity. So if the market has found liquidity here, at some point it needs to auction outside of this and go in search of the next bout of liquidity. Okay, and so that's what consolidation zones are all about. They act as very good access zones for when a market is about to break and move in one direction. We also then have key closes, something that if you've ever followed me for a long time, you'll often see me reference, this is a very important close today, or, if we close beyond a certain point, the market is a buy only. Okay, so when a market closes, and a good way to think of this, a lot of you trade, support and resistance. And what you often see is traders look at it and they say, okay, I want to be a buyer through this resistance. Very often what you actually want to be a buyer once we close beyond that resistance. Why? Because that avoids, for example, head fakes. That avoids, for example, a lot of the chop that goes on around these resistance levels. Okay, remember, resistance is not a single price. Resistance is where sellers are perhaps absorbing the market or buyers are reluctant to buy through. Okay, so at some point, once we get beyond that resistance, what it confirms to us is sellers are no longer willing to provide liquidity and buyers are now willing to initiate through that price point. Okay, so we use these key closes, whether it's a 4-hour close, whether it's a daily close, we use those key closes as access to tell us now I can be long the market because I've got that confirmation signal that it's a buy only market. Okay, so that's different types of access. The fourth one, just to illustrate it, is what we call risk event or economic data access. And how you want to think about that is very often the markets have certain structures in them. So for example, if you go look at, maybe a market that's doing something like this, where it's flagging, okay, we can all see that trade idea. We all understand that trade idea. We all recognize that if there was a bull flag coming into this, that we're all very, very bullish and we all want to be long for the break to the upside. We all have the same idea here. Okay, it's not that any of us are different. It's just when you use access methodology, at some point this is going to snap to the upside. Now, typically with economic data or things like FOMCs, these sorts of structures tend to resolve themselves. In other words, what you'll very often find is that once the key risk event is done, once it's out of the way, the market resolves itself to the upside. Okay, and I'll talk about one of these risk events in a minute when I get to the examples. So let's get to it. This is Ethereum. Okay, I'm going to use examples of the charts that are current. So we've got Ethereum right now. There's obviously news in the market. What is that news? Well, Ethereum may have an ETF at some point today. It may even be coming out as we're having this conversation. The point is that this market is very much now in a sort of consolidatory high volume absorption zone. Okay, so we can see a very high degree of volume taking place up here. The market has flagged itself in essence. So at some point, like I said, this is a consolidation zone that is likely to resolve itself through a risk event. In other words, perhaps in the next couple of hours, it's approved that the SEC is going to approve an ETF. And what will happen is this market will not only break that resistance, but it'll extend through it. Okay, and it's that risk event, that announcement, that resolves the structure. Now, what often happens as traders is we look at this and say, oh, I want to be long because it's a flag, and we preempt it. So we have the idea, and the idea might not be wrong, but we've got the timing wrong because we don't have the signal. Now, if we get that signal, if we get the confirmation from the SEC, the reality is we can buy the market. Yes, sure, we're going to miss the first bit of the move. But by the time that announcement comes out, ultimately, we've got the signal. We can manage the risk because we know exactly where that stop goes. That means we can use more leverage. More importantly, we'll get that mass participation coming in behind us. Okay. Equally, of course, maybe they deny it. Okay, if they deny, it's the same thing. This is effectively both a consolidation zone and a risk event access. So we could very easily take through that 36.32, come all the way back down to 31.70. Okay, $200 to the downside, perhaps $200 to the upside. All right, what's it going to cost you? It's probably not going to cost you more than $20 in terms of a stop. All right, so that's the idea of access. We've got this idea. We think the market's in a bull flag. We think it's going to go higher. We simply need that signaling to tell us when we want to buy or sell it. Okay, another example. This is gold from last week, from the 17th of May. This was posted in the Discord channel. We posted this little bit of a, whatever you want to call it. I don't want to call it a trend line, but what we can call it is a series of lower highs. Okay, so the market's drip feeding its way down, a series of lower highs. Now, we're looking for access to this break. We want to be long this market for a break to the upside. Okay, now, sure, we could preempt it all the way down here. We could buy the market all the way down the page, go a mile offside, and never be capable of truly managing risk. Or we can wait for the market to give us some form of access. Okay, now in this instance, we got the strong close. Okay, what you can see, I'm just going to reference it for you. If we're going to have a look at this, we got the close beyond this downward sloping line. More importantly, it took out the series of higher lows. Okay, there's your close. You can see on that close as well, we get the volume. And that's key. Why? Because mass participation must come with volume, because the volume confirms to us that someone else agrees with my thesis that this market is going to go up. Okay, without the volume, you've got nothing. The volume tells us there is that participation. Okay, now sure, in this instance, what did the market do? Yes, it washed all the way back. Okay, access methodology is not without losers. Of course you do lose on it. But the strong close confirmed to us that the market now had broken the structure. Eventually the market found its footing. It then formed a consolidation zone. Okay, so yes, we got stopped out of this access. We got the consolidation zone, which was the second opportunity, and then we got the extension move. Okay, two types of access on the gold market. Eventually, of course, gold did rally all the way back up towards record highs. Okay. Another example, and this is from Nvidia. Okay, Nvidia obviously has their earnings tonight. We're back at record highs. What do you notice? Yesterday we had an outside day, but it's a low volume outside day. Okay, an engulfing candle on its own is not access. We need the volume to confirm to us that there is mass participation in this trade. Now, what we can see here is 972. We can see that it's, I don't want to say resistance, but it's perhaps the point where the market felt it was overbought. We had a very aggressive sell-off the first time. We had a very decent auctioning process the second time. Okay, so we got very good resistance at 972. Buyers are reluctant, sellers are taking profit. Now, today, obviously, we have Nvidia earnings. Now, those earnings are going to come out. Now, sure, we can have a hypothesis about what we're willing to buy and sell within Nvidia, but what we ultimately want to watch today is if Nvidia does close, and maybe not today, but tomorrow, because the results come out after the close. But if we do stage a rally tomorrow and we close above that 972, we then closing strongly above record high territory, and that should then ignite the rally higher, okay? Because we lean on a strong close, perhaps, as the axis candle for an extension into record territory. Now, again, one thing I would say to you, keep in mind the 20-day average is at 893. The market has been sideways. We can see that moving average has been sideways for the last 2.5 months. So this market isn't necessarily overbought. And so again, keep a very close eye. We all want to play for that breakout. We all want to be long Nvidia through 972, but we need some form of access that confirms to us that everyone else is actually going to buy the damn thing. Because if we're the only ones buying it, the reality is that the market could sit in this range for another couple of days, weeks, months, years before it starts to break into record territory. Okay, so we lean on the axis that says now's the time to buy because everyone else is buying. Okay, one more example. This is from the S&P 500. Sorry, this is from the gold market actually. And again, this is an example of auctioning. Again, it's another one of those sort of trend lines where, you know, the market was very closely paying attention to it. And I just want to illustrate to you the auction process. We did get a very decent auction candle through the break. We confirmed that with the volume. Okay, so volumes accelerated through that break point. There was participation through there. There were stops going off. There was a large degree of agreement that the market wanted to push higher. Okay, and again, it failed. Right, we can see that auction failed. The market came all the way back in. And what did it do when it failed? It had a very high degree of volume on the other side, which tells us actually there was a large participation in the breakout. Right, that's what's important about volume. It ultimately tells us at the end of the day that there is participation at those various price points. Okay, however, the market established itself again, got back up above those levels, again consolidated. Okay, we had a very high volume. If you notice the volume here, all above the black line, a very high volume absorption zone before the market then began its process higher. Okay, and again, notice when the market was auctioning here, what did the volumes do? They picked up. Okay, so very, very important. Pay very close attention to volume, particularly when it comes to understanding the axis methodology.